ESG integration into the portfolio management process involves systematically incorporating environmental, social, and governance considerations into investment decisions, portfolio construction, risk management, monitoring, and stewardship activities. Rather than treating ESG as a separate investment strategy, integration seeks to enhance traditional financial analysis by identifying material sustainability-related risks and opportunities that may influence long-term performance. Portfolio managers increasingly recognize that ESG factors can affect company valuations, creditworthiness, asset prices, and market behavior. Effective ESG integration therefore aims to improve risk-adjusted returns, strengthen portfolio resilience, and support long-term value creation. The approach can be applied across asset classes, investment styles, and portfolio management frameworks. One common approach is ESG incorporation within security analysis and selection. Portfolio managers assess material ESG factors alongside traditional financial metrics when evaluating investment opportunities. Analysts may use ESG scorecards, company disclosures, ESG ratings, management assessments, and proprietary research to identify sustainability-related risks and opportunities. Environmental issues such as climate exposure, social considerations such as workforce management, and governance factors such as board effectiveness are incorporated into investment recommendations. Securities demonstrating strong ESG performance or effective management of material risks may receive more favorable assessments, while companies with significant ESG concerns may be subject to additional scrutiny or reduced portfolio weighting. Another widely used approach involves portfolio construction and weighting adjustments based on ESG considerations. Portfolio managers may tilt allocations toward companies, sectors, or issuers with stronger ESG characteristics while reducing exposure to those with elevated sustainability risks. ESG scores, ratings, or proprietary assessments may be incorporated into optimization models and asset allocation decisions. Some portfolios apply minimum ESG thresholds or weighting methodologies that reward superior ESG performance. This approach allows investors to maintain diversification while systematically integrating sustainability considerations into portfolio design. The objective is not necessarily to exclude investments but to improve overall portfolio quality and long-term risk-adjusted performance. Screening approaches also play an important role in ESG integrated portfolio management. Negative screening excludes securities associated with specific activities, industries, or practices that do not meet predetermined ESG criteria. Positive or best-in-class screening focuses on selecting issuers with relatively strong ESG performance compared with peers. Norms-based screening evaluates compliance with international standards and principles related to environmental protection, human rights, labor practices, and governance. These approaches help align portfolios with sustainability objectives, regulatory requirements, or client preferences. Screening methods are often combined with broader ESG integration techniques to create more comprehensive portfolio management frameworks. Portfolio managers increasingly incorporate ESG risk management and scenario analysis into ongoing portfolio oversight. ESG risks such as climate change, regulatory developments, social controversies, governance failures, and resource constraints can affect portfolio performance over extended time horizons. Investors use stress testing, climate scenario analysis, carbon footprint assessments, and risk mapping techniques to evaluate portfolio exposure to sustainability-related risks. Continuous monitoring enables managers to identify emerging issues, reassess investment positions, and adjust portfolio exposures when necessary. Integrating ESG considerations into risk management processes enhances the ability to anticipate long-term challenges and improve portfolio resilience under changing market conditions. A final and increasingly important approach is active ownership and stewardship integration. Portfolio managers use engagement, proxy voting, collaborative initiatives, and dialogue with issuers to influence corporate behavior and encourage improvements in ESG performance. Stewardship activities complement investment selection by allowing investors to address material ESG concerns while maintaining ownership positions. Effective portfolio management, therefore, extends beyond buying and selling securities to include ongoing monitoring and engagement. By combining security analysis, portfolio construction, screening, risk management, and stewardship activities, ESG integration creates a comprehensive framework that supports informed decision-making, strengthens risk management, and promotes sustainable long-term investment outcomes across a wide range of portfolio strategies and asset classes.